Welcome to Decoding Retirement. Hi, I'm your host, Bob Powell, and today we're going to go behind the headlines with Liz Ann Sonders. She's the Chief Investment Strategist at Charles Schwab. Liz Ann, welcome.
Well, thanks for having me, Bob. Nice to be here. And welcome to Impact.
Yeah, thank you. I've been here before, and I love coming
Welcome
here.
again to Impact.
Thank you so much. But I go way back. I think I went back to like when David Pottruck was still here. And so I've been, a long time lover of Impact.
Yeah, my first one was in 2001, so...
About the same time, I think, yeah. So we're going to go behind the headlines. Yesterday, you gave a speech, and you gave the folks here who are attending Schwab Impact a lay of the land. You talked, I think, about tariffs, deportation, the Tax Cuts and Jobs Act being extended, and sort of help us boil down what you said in 50 minutes into like 5 minutes.
It's overused to talk about uncertainty and the impact it has on markets, but I think this is a uniquely high amount of uncertainty, not just because of the knowledge we have of Trump and the first administration, but how policy got affected, especially on trade in that 2018 period, where it was often by tweet. So that's an added wrinkle into trying to figure out what's going to happen when and to what extreme. I think that tariffs are shocking to me. In that they're really misunderstood. And it's one of the reasons, and I talked about this last evening, that I'm a real stickler with the way headlines read about tariffs. I think there's a shortcut where you'll read something like tariffs on China. And I think that does a disservice to the listening or reading public because the exporter, in the case, doesn't pay the tariff. It's the U.S. company importing. The effect, the actual physical writing of the check is by the U.S. company. And then the question is, do they pass those higher costs on, which for the most part they do? Then what, if anything, is the retaliation? Is it done via tariffs on products coming out of our country? Or does it happen in the currency markets? Is it a negotiating tactic? But unique uncertainty. But you add to the mix the extremes of deportation and the fact that both tariffs and immigration, most of those policies can be done via executive order, don't have to go through that congressional. So it could happen fairly quickly. I think it's hard to argue against the case that some combination of mass deportations and tariffs, it's hard to argue against them being inflationary and suppressing growth. So that's why you're seeing a lot more reference to the term of stagflation, because of the potential we see lower growth and higher inflation. Maybe the ultimate end is worth it, but that's the near-term implication that we're facing.
So we like to decode terms here on our podcast, and stagflation is probably a term that people haven't heard in a long time. Describe what the impact of stagflation is.
So at the time that term was first used back in the 1970s, it wasn't so much about weaker growth in the broader economy. It was more specific to a rising unemployment rate alongside high inflation. Now I think the term is used a little more broadly to talk about a period of lower economic growth and higher inflation. So, and that's not a great combination, obviously. The thinking on the part of the administration is that it would be sort of a short-lived amount of pain necessary for ostensibly the long-term gain. But I'm personally not. We've heard that story before. Smoot-Hawley, 1930s. Right. So I'm not a huge fan of tariffs. I don't think they're well understood. Yeah. But it's what we are likely to have to live with. Yeah. And, it has implications for the equity market and obviously has implications for the bond market, too.
Yeah, I want to talk about those implications. But as you're talking about tariffs, I'm reminded that McKinley was among the first to sort of implement these tariffs. But they were strategic, if my memory is correct. And they weren't blanket across the board. They were more sort of surgical.
Right. Yeah. And same with under Nixon as well. And once they had the intended effect, they were taken immediately off. That doesn't appear to be in the cards this time, but we don't know yet. So you have to be really careful about extrapolation. That said, it is having impact already. There was a Wall Street Journal article just, I think today or yesterday, about all of the massive pre-ordering to get ahead of tariffs. And so we actually could see a big change, a big shift in the trade deficit near term. And oddly, that might fuel the desire to do more. So it's sort of this circular thing, but it's a tough environment to try to plan.
So there's a lot more that we haven't talked about. Tax Cuts and Jobs Act being extended more likely than not. The wars that are going on.
I don't know about a full extension of the 2017 tax cuts, because not every Republican is in favor of that.
Yeah.
And if in the meantime, because that doesn't expire until the end of next year, in the meantime, if there is any sort of pushback from markets, maybe the bond vigilantes on the fixed income side of things, that could send a message from the deficit and debt perspective that they're just, we can't afford to do all of it, even if there's some of it ultimately either that gets extended or there's the proposal of lowering the corporate tax rate even more. So we don't know whether there'll be pieces pulled out of that and put higher on the priority list.
Yeah, well, I know you said uncertainty is a well-used phrase at the moment, but given that uncertainty, how should those saving for or living in retirement, what adjustments do they need to make to their portfolio, either strategically or tactically?
I don't know if there should be any adjustments specific to this election-related and policy-related uncertainty, because then you're trying to sort of game what's going to happen, and then in turn guess what the reaction on the part of markets is going to be to what we are guessing will or might happen. So I think that's fraught with peril. And in general, we would advise that. I think there's a lot of extrapolation that happens around an election of what is this good for? What does it mean for certain asset classes? And it's kind of a fool's errand. So I think any planning for retirement should still go back to the basics. And I think one of the most important things really for any investor, but certainly becomes more important as you approach retirement, where there's less of a time frame. There's that, in many cases, there's that need for income generation as well as capital preservation. I think one of the best things for investors to try to do all along the path to retirement is try to figure out, before you figure it out the hard way, whether there is a wide or narrow gap between your financial risk tolerance and your emotional risk tolerance. Financial risk tolerance is what basically goes figuratively on paper.
Right.
What's my time horizon? What's my need for income?
What's my risk capacity?
Right. How much? But then there's the emotional risk tolerance of, your first bear market experiencing, and you freak out and panic and sell.
Yeah.
That means your emotional risk tolerance and your financial risk tolerance are completely disconnected. Yeah. So, and that becomes more important to see to try to gauge whether there's a wide or narrow gap between those two the closer you get to retirement.
And it's hard. I remember in 2008, I was sitting at a lunch during the middle of as the crisis was unfolding in 2008, sitting across the table from a financial advisor who said to me, I'm beginning to doubt everything I ever told my clients, because the markets were in a free fall at that time. But as I think about what could happen, right, we're watching interest rates rise potentially even more. And if you're in a traditional 60-40 portfolio, you're watching the value of your bond portfolio decline, and possibly a break with stocks too, that you might be sort of having that 60-40 portfolio not the diversification won't be beneficial, perhaps, right? You might experience.
Well, if you're trading on the fixed income side of things, on the bond side of things, then you run that risk, because in the process of long-term interest rates going up, of course, bond prices are going down. But the reality is, now that we're in a higher interest rate backdrop relative to, say, global financial crisis era, post-COVID era of 0%, Fed funds rate. If you are extending duration, if you are taking a hold to maturity approach, you're generating income along the way, and you ultimately are not going to lose that principal. Right. So I think that's the misperception around, say, the whole 60-40 notion. What's also important, though, and I think this becomes increasingly important as we think about the relationship between bond yields and stock prices in the short term, is I think we're definitively out of the Great Moderation era, which was generally seen as the mid to late 90s up until the first couple of years of the pandemic. And that was an era during which almost the entire time bond yields and stock prices moved in the same direction, because we had very little inflation. So when bond yields were going up in that era, it was often because growth was improving without a big inflation problem. That's nirvana for equities. The period before that, for 30 years, from the mid-60s to the mid-90s, was the complete opposite.
Right.
Almost the entire period of time, you had an inverse relationship between bond yields and stock prices because yields were more connected to what was happening in inflation. So periods where inflation was going up had reaccelerated, bond yields were going up, not great for the equity market. We're back in that kind of correlation territory. And I think if it were to persist, I think that's sort of the proof statement to this idea that the Great Moderation is a thing of the past. And even if we don't have high inflation for an extended period of time, which I don't think we will, most likely more inflation volatility. And I think that's already part of the reason why we've had more volatility in the bond market. And I think could contribute to some spikes of volatility in the equity market too.
Right. So as you think about someone who's retired, they have maybe a classic 60-40 portfolio, they're depending on the interest income from their bonds. Do they they may have a fear of missing out, right? That they're saying, oh, look at the yields that are now I could get, but I can't sell because I'm going to get a loss in my portfolio if it's a taxable account.
Well, so I think the fixed income side of portfolios, I think require a more nuanced approach maybe than the equity side of portfolios, where it has to be geared toward the investor. What are their income needs? What are their concerns about short-term fluctuations? And that's one of the reasons why at Schwab we have lots of bond specialists. Not that there is a blanket recommendation of what to do on the equities side. Equities can be complicated too, but I think that customization is much more important on the fixed income side of things. But we also have to remember, I know it's generic to talk about 60-40. The opportunities for individual investors to have asset allocation go well beyond just the traditional stocks, bonds, cash has never been greater, and it's getting more abundant. There's more democratization of other asset class and alternatives. So individual investors at very little cost can afford themselves sort of almost a foundation endowment kind of approach with having greater diversification outside of just those traditional two asset classes. So I think a lot of folks, whether they're well before retirement or approaching retirement, should avail themselves of that opportunity to find diversification, to find uncorrelated assets outside of just that traditional approach, even if we still generically talk about 60-40. Yeah.
So, Liz Ann, we have to take a short break, and then when we come back, we're going to talk more about your 38 years in this business. Okay. So stay tuned. Welcome back to Decoding Retirement. I'm talking to Liz Ann Sonders. She's the Chief Investment Strategist at Charles Schwab. Liz Ann, I promised before the break that we would talk about your almost now 39 years in the business.
Yeah.
So that means you started like when you were 1.
Oh, no. I just had the big 6-0 a few months ago. So.
All right. Well, so I started in 1984, so we at least share something in common right. there. In that time, you've had a chance to interview some of the all-time greats in the investment industry. And I want to start with, I think, the person who I think maybe among your sort of most beneficial mentors, which would be Charles Schwab.
Absolutely.
So talk more about like what you've learned from Charles.
Oh my gosh.
Chuck.
It has been an extraordinary 25 years working at Schwab. So I've actually only had 2 jobs in my almost 39
I've had
years,
like 15,
which is somewhat unheard of, but the past 25 years. I think what Chuck has brought into the world of investing is really extraordinary. He is the ultimate disruptor, but has done it with such grace and such an ethical compass, with a desire to disrupt, but all focused on the individual investor and doing what's right for the individual investor, and starting a company on the West Coast, not on the East Coast, and just taking a very different approach relative to the traditional Wall Street firm. And that was always so admirable. One of the things that Chuck has always said that I think has always resonated with me, but it's usually one of those takeaways people who have read his books or they hear him speak, is his idea that investing by its nature is an act of optimism. And I think it's important to sort of have that in your gut and in your bones and in your psyche. And it's hard at times to sort of maintain that optimism. We're just bombarded by noise and negativity. And, we just put out a documentary on Chuck and the founding of the firm 50 years ago. And there's one visual in it where he's just very calmly talking to someone interviewing him. And he just does this and says, this is what happens. And you've got to maintain that discipline. And he just the way he talks about that and the knowledge that anyone listening or watching has of just how long he has been doing this and doing it sort of on the straight and narrow. So that optimistic instinct has to stay with you, even when you're in some of the more dire periods of time. He has had such grace under pressure that I think he's imparted that to a lot of us. And I rely on that at times where maybe my gut is churning a little bit more than...
Calm on the outside.
Yeah, calm on the outside. And keeping that really long-term perspective. And also understanding that we think of markets and investing as this one big thing, but it's a huge difference when you are serving individual investors versus, say, serving institutions and hedge funds and the benchmark approach. And
it's people's money.
It's actual
real,
people's. And it matters a lot to them. So that is what has resonated.
So two things as I think about Chuck is I had a memory of going to an investment company institute general membership meeting many years ago. Chuck, Ned Johnson, and Jack Bogle on the stage.
Oh, wow.
And it was an amazing thing to see these three icons talk about their philosophies and whatnot.
Yeah, I got to know Jack fairly well, and he was another just incredible
guy.
Yeah.
I got to know Jack pretty well, too.
Yeah.
But talk about Chuck and this notion of, you were talking about democratization of investments, right? We're now witnessing like people have access to private assets in ways that were only available to high net worth investors before. But now we're watching, and Chuck has, in a way, democratized money.
Oh, absolutely. From just establishing the first, discount brokerage firm and changing the rules of the game in terms of how much money you had to have to have that opportunity to invest. In the old days, it was, through private banks, and you had to be incredibly wealthy. So that was sort of step one. And there have been so many other steps along the way in bringing access to mutual funds, to individual investors.
Money market funds. And
I think last I checked, Schwab might have had a little bit something to do with the move to 0% commissions.
I seem to recall. Memory serves.
So, that was another huge example of really bringing investing to the masses. And now the access to information and advice. One of the cool things that Schwab has always done is all of our research, including mine, is all on our public site. You don't have to be a client. Even if you're a client, you don't have to log in. It's just, if you know how to type in schwab.com, you can get all of our research. So providing that out into the public domain without restricting it to just our clients has been important. And now, and we're now offering an alternatives platform for smaller investors. So it's very early stages, so I won't go into a lot of detail, but that's the most recent example of democratizing investments, all for the benefit of individual investors.
Yeah. So along the way, you have a podcast and you've interviewed numerous giants in the world, Scott Galloway, Sebastian Page. Talk maybe a little bit about some of the lessons you've learned from the folks.
You know who else I interviewed on our podcast? Chuck Schwab himself.
Oh.
So that was a fun one. Scott, I've gotten to know Scott Galloway. He has spoken at a number of Schwab conferences, and he and I really clicked, and we're almost the exact same age. So we stay in touch, and it was a real treat to have him on. And he had just come out with his book, The Algebra of Wealth. And it's just a really unique look at how to build wealth. Spent a lot of time talking to him about what was in his book, which is not so much what matters, but just as important as what doesn't matter. And one of the interesting things that he talked about was sort of talent versus passion. And that we generically often think, we should follow our passion. And he said, follow your talent. And if you end up doing something with which you have great talent, that's going to generate passion. You might have passion for something, but if you're not talented at it, that's a bit of a disconnect. He also talked a lot about the adversity he has had in his younger years. Not being financially secure, making poor decisions, and that was an important takeaway of what we can learn from those processes over time. Understanding how important it is to start young. He's a big proponent of financial literacy. I cannot believe we don't teach financial literacy, at least at the high school level, if not earlier. I remember when
it's happening.
It is happening, but slowly.
Slowly.
I remember my kids are now 28 and 24, but when they were in high school, I lived in Darien, Connecticut, fabulous high school, and I made myself such a pest with the principal, saying, why don't you bring a financial literacy course in? And her response was always, well, we have the stock market club. I said, that's not what I'm talking about. That's one tiny little piece of it. What's an IRA? What's compound interest? What's taken out of your paycheck? How do credit cards work? The basics. So his passion around that resonated with me and with us at Schwab because it's such a big mission on our part around financial literacy.
I just gave a speech where I had to reference some of the work that Anna Marie Lusardi and Olivia Mitchell have done. And the notion is high school works, but it also needs to be continuous. As you enter the workforce, you still need to encourage people because oftentimes in high school, you may not have a credit card.
Right.
So you don't necessarily...
It's not sort of applicable day to day when you're in high school.
But when you're right. When you get to the workplace, you're like, oh, I get what diversification is. I get what a S&P 500 index fund is, whatever. Liz Ann, we've run out of time. I apologize. I could go on forever.
Me too.
But I want to thank you for sharing your knowledge and
My
wisdom
pleasure.
with us and our viewers and
My
listeners.
pleasure.
Thank you so much.
Great to be here. Thank you.
Thank you so much.
Thank you.
And now it's time for a segment that we call Ask Bob, where we answer a reader's question. And the reader's question goes like this. I withdrew money from my IRA before turning 55. Do I have to pay a penalty? And the answer is yes. If you withdrew money from your IRA before age 59 and a half, you generally have to pay a 10% early withdrawal penalty in addition to any income tax owed on the distribution. However, there are some exceptions to this penalty, such as unreimbursed medical expenses, disability, or certain educational expenses. So if you have questions about personal finance or retirement, we're here to help. Email me at askbob@yahooinc.com, and we'll do our best to answer your reader questions in a future episode. That's it for this week's episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. And don't forget, for more retirement news, check out yahoofinance.com.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.